On behalf of CNBC TV18, I welcome you all to the Informed Investor on-ground forums, which National Stock Exchange and CNBC TV18 are doing together. The Informed Investor is our little humble attempt to try and outline what are the right ways to invest. I really don't think there is a debate anymore on whether one should invest or not invest. I don't even think that's an option. It is not an option to any of us. What is an option is to know how to correctly invest. Let me introduce our two experts. The two guests who are here today are people who have spent many, many years in their respective parts of the financial market that they've been associated with. Mr.Dinesh Thakkar, who is here, has almost 3 decades of understanding of the markets. He's the chairman and managing director of Angel Stock Broking, one of India's biggest broking houses. He has been closely involved with investor education himself. And there is Rajiv Anand, who is the CEO of Axis Mutual Fund. Again, someone you've probably seen several times on our channel. Someone who comes with a very deep understanding of both the debt markets as well as the equity markets. I will first request Mr. Dinesh Thakkar to come up and make his presentation.
For any individual to make wealth and money in this market, it is important that he grows his wisdom on his own. He has a conviction on this asset. When I came to this market to raise seed capital for my own business, I lost almost 50% of my capital. That was because at that time, during 1988-90, brokers never used to take effort to educate customer, educate investors that what is right and what should be their approach. Believe me, investing or creating investment strategy is not a rocket science. It is very simple. But many times we are clouded with noises that we hear which may not be relevant to the market. And we shy away, we don't invest in this market, losing a big opportunity. You may be seeing in the market there is lots of volatility. It's very difficult to predict where the market would be in a short run. And many times we try to extrapolate the trend that maybe market will not recover, maybe market will not say cross previous highs. But if you look in the history, you will see equity has performed really well. Equity has almost given and compounded annual return of around 18%, excluding dividend of 2%. So this is an asset which has given you 20% return. You can have a conviction on this asset class that yes, this is an asset class which can give me a long-term benefit. Coupled with power of compounding, which Albert Einstein has regarded this as an 8th wonder of the world, you will see if you had invested 1 lakh rupee in this asset which grows at 18 to 20%, in 10 years your asset value of your asset becomes 6 times. In 15 years it becomes 15 times. Next 5 years, 20 years it becomes 38 times. 25 years is almost 95 times. Compare this with the returns that you will get when you put this money in a risk-free bank deposit. Even after 25 years, your asset would be just 6 times. So you'll understand what is important is that you should get an asset which can give you a good compounded return, and then you should have some patience and keep and allow that money to grow. But at the same time, it is important for you to have a conviction that is it what has happened historically is going to be repeated, or is it that now we'll see a different trend altogether?
Wealth is not created overnight, it is created over time. So therefore you need to stay invested for long periods of time for you to be able to create wealth.
When we look at market trend, in a short term we may feel that it is influenced by lots of newses, lots of noises on what is going to happen, which may not have a material impact on corporate earning. So if you look at the trend of our GDP growth and a market cap, almost it goes hand in hand. So appreciation in stock market is nothing but it is about meeting your aspirations, it's about meeting your goals. GDP is nothing but how you have progressed, how you have prospered. India has shown resilience during this global financial crisis, where our economy, even in that crisis period, grew at the rate of around 6.5%. And we are expecting our GDP to grow at around 8 to 9% in coming next few years. Our corporate earning has been growing at the rate of 21%. So there was a period after Lehman Brothers crisis that our corporate earning started consolidating, because we also, like the globe, we expanded our capacity. It takes time for it get to optimally utilize, and now we are back on a growth trajectory. This corporate earning is back on a growth trajectory of around 26%. So definitely this trend would be reflected in stock prices, but it may not have a correlation on day-to-day basis. But if you have a conviction that, okay, if this corporate earning is going to grow at a rate of 26%, so in a block of 2 years, you will see stock prices mirroring the same trend. Is this the trend only for 2 years? No, I don't believe so. So it's a long way to go before we plateau, before our growth rate comes down to 3%, 4%. Until that time, I am confident that our GDP will grow at the rate of 8 to 10%. In our market, ignorance is not a bliss. Ignorance is something like a surgeon with half knowledge does an operation on a patient. So nobody would like to go to a surgeon who has a half knowledge. Similarly, when you invest in this market, you need to have a good knowledge about investment tools that we use, valuations ratios that we use. Most often I have seen investors doing a mistake of buying stocks with a low PE. But many times you get trapped. You say that, okay, I was really right in terms of buying stock with a low PE. Then suddenly after 1 year or 2 years, I realized that my stock is having a high PE. You have to look at business cycles. For example, when you invest in sectors like cement and sugar, always it's a cyclical business. Always up cycle is followed by a low cycle. And at the up cycle, company earn around 30% on their capital. In the low cycle, they earn around 5%. So if you buy this stock in an up cycle when they are earning 30%, you may have bought the stock at 10 PE. But with the low cycle, when actually this return on their equity becomes 5%, same PE becomes 60. So without any change, you will realize that, okay, I wanted to buy a low PE stock, and suddenly you are stuck with a stock which is having a very high PE. Hence, you have to look at an historical ROE. Similarly, for this sector, if you look at an historical ROE, you may conclude that historical ROE is just 14 to 15%. So I need not pay more than that historical ROE what a company can earn. So it is better you use a price to book value and conclude that I will buy this company only when it is available one time to book value, immaterial of their earning. Second is you have to differentiate between tangible and intangible asset, because tangible asset will require lots of capital for their expansion. Intangible would be having a different ROE. So when you are investing in a company which is into intangible asset, you have to pay some premium and you will get a good rewards in that. Third and very important, integrity test. Before you invest, don't get lured by low PE, low price to book value. Many times sales figure in balance sheet are inflated. So you need to be careful. Last and very important, sorry to use a cliche over here, give the man a fish and you will feed him for a day, teach him fishing and you will feed him for a lifetime. I would say we need to go much beyond that. As I told you that we can provide you intelligence, but you have to gain your own wisdom.